As rate hikes, inflation, and the sharp rotation into low multiple stocks look set to define global markets in 2022, a lot has now changed with the crisis in the Ukraine. James, can you provide an overview of how the events of the last few weeks have impacted the portfolio?
Yep, certainly, Alison. Firstly, the Antipodes global portfolios have no direct exposure to Russian or Ukrainian companies. Both the global and global long strategies have outperformed the benchmark in February, which extends January's solid relative return. We do think some of our more economically sensitive exposures in the portfolio will be challenged while uncertainty is high. For example, our European financials have taken a hit, but somewhat offsetting this, our exposure to energy, materials, defence and gold stocks have protected portfolio performance.
We've been talking about the tail risk of stagflation for some time now, given the build-up of inflationary pressures in the system. Now, the situation in the Ukraine has arguably intensified this risk of stagflation, given the move in commodity prices to multi-year highs. And this is adding to above-trend growth in wages and rent. Now, stagflation, which is an economic growth disappointment coupled with an inflation shock, it is going to be a challenging environment for weak cyclicals and weak and expensive growth companies. So how are we approaching this?
Yes, I think you're correct in saying the risk of stagflation has intensified. The longer the conflict continues, confidence will be affected and businesses will be reluctant to invest. And this will unfold against a backdrop of higher inflation. The pressure that we're seeing in energy and commodity prices may be stickier than investors realised. Russia and Ukraine are large exporters of not just oil and gas, but also steel, fertilisers, aluminium, nickel, timber, grains like wheat and corn, and finally sunflower oil. So this is a second supply side shock on top of the yet to be fully resolved COVID supply side shock.
And with costs rising on so many fronts, naturally this will impact corporate profitability.
Exactly. And in prior market or economic downturns, the Fed has responded via monetary easing in the form of QE. But higher and stickier inflation may mean the Fed's hands are now tied. So higher yields will be a challenge for weak and expensive growth businesses. And we would expect to see multiple compression in the growth complex. But you don't want to just own any low multiple stocks because weak cyclicals won't perform if economic growth disappoints. So we're focusing on resilient businesses with attractive valuations that can protect profitability and take market share against a backdrop of higher inflation and tougher economic conditions.
Okay, so what are some stocks Antipodes has been adding to as volatility and uncertainty has risen over the last few weeks?
We've been adding to affordable quality via SAP and Oracle, which along with Microsoft form our reasonably priced enterprise software cluster. SAP and Oracle are good examples of resilient businesses with reliable demand, pricing power, and can provide protection against inflation. Over the last 2 decades, we've seen key pieces of the enterprise management systems move to the cloud. A good example is Salesforce, which is a cloud-based CRM system rather than on-premise traditional CRM systems. But the core ERP software, the general ledger or financial software and attached systems remain on-premise. ERP or enterprise resource planning, to say it in full, is the software that businesses use to manage day-to-day activities like accounting, procurement, supply chain management, etc. And these businesses or their customers were very reluctant to move the core ERP to the cloud. Now, there are several reasons for this historically, but one of the core reasons was security. Now, when COVID-19 hit and businesses had to be run remotely, it shone like a spotlight on how challenging it is to manage your businesses if a key piece of the software remains on-premise, and especially to manage them securely. So ERP systems couldn't really adapt to the new world we're now living in, which is a hybrid working from home and office remotely environment. As a result, moving core ERP to the cloud has become a high priority for CIOs and CFOs alike. And SAP and Oracle have the leading market products in SaaS ERP. From a customer perspective, the economics just make sense. So over the 10-year life of a contract, a cloud or subscription-based customer is worth twice that of an on-premise customer to SAP or Oracle, as they're providing not just the software, but also the IT infrastructure and facilitating the updates that reduce the need for companies to pay for consultants or in-house labor to manage and maintain the systems. And so we see SAP and Oracle take that pricing advantage as a result of this, but also deliver savings to customers. On top of this, transforming to the cloud significantly increases SAP or Oracle's customer base. Both companies dominate with the world's largest companies, but a subscription-based cloud service is much more affordable to smaller enterprises, and it comes with upgrades and support. So we think SAP and Oracle could take further share in the ERP market. It's also clear from various work that we've done that both companies are reaching an inflection point where cloud ERP is now a meaningful part of their businesses, and it's lifting overall consolidated revenue growth. So between SAP and Oracle, we have two companies that could see revenue growth accelerate. We think even in a weaker economic environment, as businesses continue to transition core or even begin to transition core ERP to the cloud in many cases. They both have strong pricing power as they are the market leaders and can protect profitability against rising costs. Both will see mid to high single-digit earnings growth and are valued at 16 to 20 times earnings, or 16 to 20 times PE ratio. We think that's an attractive valuation relative to their growth profile, and they're incredibly cheap relative to their peers.
Thanks for your time, James.